What's up guys, and welcome back to Wall Street Millennial. On this channel, we cover all things related to stocks and investing, usually covering epic gains and losses on the Wall Street Bets forum. In this video, we're going back in the history books to cover one of the greatest investment disasters during the financial crisis. If you haven't guessed from the thumbnail, we're talking about the failure of the investment bank Bear Stearns. Bear Stearns was a major investment bank at the time and was very involved in the subprime mortgage market. Similar to Lehman Brothers, its failure is widely regarded as one of the key contributors to the 2008 global financial crisis. But unlike Lehman, the Federal Reserve controversially bailed the company out. Many, including Lehman Brothers CEO Dick Fuld, thought this was unfair and a blatant example of the Fed picking winners and losers. In this video, we'll go over the history of Bear Stearns, what led up to their failure, and whether or not their bailout was justified. Founded in 1923, Bear Stearns built a reputation as a leading investment bank over almost 100 years. During the Great Depression of the 1930s, while most banks went bust in the face of unprecedented bank runs and uncertainty, Bear was able to survive without laying off a single employee. Over the years, they built up a global, diversified investment banking operation which included mergers and acquisitions, securities trading, and most importantly, a premier asset management business. They IPO'd on the NYSE in 1985, and the stock price increased significantly over the 1990s and 2000s, reaching a peak of $170 per share in 2006, giving the firm a market cap of over $9 billion. They grew profits rapidly and quickly became one of the most prestigious companies on Wall Street. Even in 2007, 1 year before the financial crisis, Fortune magazine ranked Bear the second most admired securities company, right behind Lehman Brothers at number 1. Throughout the 2000s, Bear built out a world-class asset management business, which made its investors a lot of money by making highly leveraged investments in the US mortgage market. In the early 2000s, the Federal Reserve cut the federal funds rate to 1%, which was unprecedented at the time. This made the cost of getting a mortgage extremely affordable, and a record number of American families were buying their first homes. This increased demand sent real estate prices soaring, more than doubling from 2000 to 2006. While homeownership is certainly a good thing, prices were rising too far too fast, causing a real estate bubble that ultimately took down the global financial system. With prices steadily increasing, construction companies started aggressively building new homes, which eventually led to oversupply. Furthermore, with prices only going up, homeowners could always refinance their mortgages at a higher valuation if they were ever behind on their payments, so foreclosures were almost non-existent. Because of this perceived sense of security, mortgage lenders were willing to underwrite so-called subprime mortgages to borrowers who typically would not be approved for conventional loans. These risky loans represented more than 20% of new mortgage originations at the peak. Bear Stearns saw the potential of the mortgage market early on, and the CEO, Alan Schwartz, aggressively expanded into the mortgage business by setting up 2 hedge funds that would invest in subprime mortgage securities. With their stellar reputation on Wall Street, these funds were able to raise billions of dollars from respected institutional investors, including Barclays Bank. The strategy of these hedge funds was to buy subprime residential mortgage securities, but these mortgages only yielded 5 or 6%, which is not nearly enough return for a hedge fund. To supercharge their returns, they employed unprecedented amounts of financial leverage, with the debt-to-equity ratio reaching 36 times at the peak. To put this into perspective, Robinhood only allows users to take out margin equal to 1 times their equity value. Bear was able to take on such extreme amounts of leverage because of their powerful financing resources on Wall Street. Because Bear Stearns was such a highly admired firm, with billions of dollars and thousands of top talent in its offices, lenders were very confident in the firm's credit. As a result, they were able to borrow hundreds of billions of dollars of cash to shovel into these highly risky assets. Their profits were growing at an outstanding clip on the back of strong double-digit revenue growth. This growth outpaced that of most of the other major investment banks at the time, thanks to their subprime mortgage strategy, with the exception of Lehman Brothers. This was only possible through an accumulation of a highly leveraged balance sheet. By 2007, Bear Stearns had about $70 billion of capital, but held more than $1.85 trillion notional of options and futures contracts. In addition, they held $28 billion in what they called Level 3 assets, which are basically assets that are in some way difficult to value, so the bank can just put whatever value they want on them within reason. And at that particular time in history, almost anything qualified as within reason. Overall, Bear Stearns had $11 billion of net equity, supporting $400 billion of assets for a 36 times leverage position. At this rate, it wouldn't even take a 3% drawdown in the value of their assets to wipe out their entire equity. In 2007, cracks started to appear in the housing market. The Federal Reserve started raising interest rates in 2004, and by 2007, they had increased to above 5%. This was a problem because many homeowners took out variable rate mortgages when interest rates were at 1%. With rates rising, many homeowners saw their mortgage payments double. Many of these subprime borrowers could barely afford their payments at the low interest rates, so they were forced into foreclosure as they couldn't make these high payments. At the same time, housing prices finally started to decrease in light of the massive new home supply built up by the construction boom over the previous decade. With prices falling, mortgage lenders got scared and started tightening their lending standards, decreasing demand for new homes and driving prices down even further. This caused a death spiral of lower prices and high rates of foreclosure, ultimately leading to a 30% decline in home prices from peak to trough. The ensuing tightening of credit markets impacted not only the real estate industry, but had ripple effects on the broader economy. Banks were unwilling to provide lines of credit to Main Street business and industrial giants like GE and the Detroit automakers. This led to waves of layoffs and economic devastation. The increased levels of foreclosures caused the mortgage-backed securities Bear was holding to tank in value. Because they had taken on so much leverage, their financial counterparties started to fear they would not be able to pay back their loans. Rumors of Bear Stearns' ability to service financial contracts contributed to worsening counterparty risk in its financial dealings, with Goldman Sachs reportedly refusing to deal with Bear Stearns on the concern that they would renege on their contracts. However, on CNBC with host David Faber, Bear Stearns CEO Alan Schwartz insisted that there is nothing to worry about.
Yesterday, still down 17% over the last 5 trading sessions. Joining me now first on CNBC is Alan Schwartz. He is Bear Stearns president and CEO. Mr. Schwartz, thanks so much for being here this morning.
Good morning, David.
Good morning. Let me start off with this broad idea that's been in the market now for a few days and pressuring your stock, namely that counterparty risk is something, new counterparty risk is something that a number of firms on Wall Street no longer want to take in terms of dealing with Bear Stearns. Is that true?
No, it's not true. There's been a lot of volatility in the market, a lot of disruption in the market, and that's causing some pressure administratively on getting some trades settled out, but we're working hard getting that done. We're in a constant dialogue with all of the major dealers and the counterparties in the street, and we are not being made aware of anybody who is not taking our credit as a counterparty.
All right, so when I'm told by a hedge fund that I know well that last night they tried to close out a mortgage, a credit protection mortgage position with Goldman Sachs that they had bought a year ago, Bear was the low bid, and I'm told that Goldman would not accept the counterparty risk of Bear Stearns. You're saying you're not aware that that would be the case?
I'm not aware, and on a specific trade from one counterparty to another, and where you're a third party, we have direct dealings with all of these institutions, and we have active markets going with each one, and our counterparty risk has not been a problem.
Why is all this out there to begin with? I mean, what do you think is causing these rumors? The stock yesterday recovered after being down as much as 11%, but as I said, it has been quite weak. The company has denied, and you're saying here there are no problems. So where does all this come from?
Well, it's very hard to say.
Alan Schwartz also reported to Congress that these worries about Bear Stearns were just rumors and that there was nothing to see here.
Before unfounded rumors began circulating in an already precarious credit market, leading to the run on Bear Stearns, the company had adequate capital and liquidity and a book value of approximately $12 billion.
Despite the obvious stress on Bear's balance sheet, many market participants still believed in the company and Schwartz's ability to avert bankruptcy. Notably, CNBC's Jim Cramer told his viewers not to sell Bear stock in 2008 when it was at $60 a share.
Okay, Peter writes, should I be worried about Bear Stearns in terms of liquidity and get my money out of there? No, no, no. Bear Stearns is fine. Do not take your money out. This is really, look, if there's one takeaway other than a plus 400 somewhere, Bear Stearns is not in trouble. I mean, if anything, they're more likely to be taken over. Don't move your money from Bear. That's just being silly.
On July 16, 2007, Bear Stearns disclosed that its 2 subprime mortgage hedge funds had been completely wiped out. Merrill Lynch then seized $850 million of CDOs from Bear Stearns, which turned out to be worth only about 10% of the stated value when they tried to auction them off on the open market. On August 1, 2007, investors in the 2 subprime funds took legal action against Bear Stearns for misleading investors about the risks they were taking. The law firms Jake Szymanski and Associates and Rich and Intellisano filed claims against Stearns with the National Association of Securities Dealers. Co-President Warren Spector was forced to resign 4 days later. On June 19, 2008, 2 managers of the subprime hedge funds were arrested, facing criminal charges for misleading investors about the risks they were exposed to. They were also sued by Barclays Bank for the same reason. Barclays claimed that the managers knew that certain assets in their portfolio were actually worth much less than their professed values, and used them in a strategy to make more money for themselves in fees. At the same time as these risky assets were plummeting in real value, Bear Stearns reported the funds were up 6% in 2007. One of the investors in the subprime fund was Jeffrey Epstein, the disgraced financier who most people believe killed himself in August 2019. Epstein actually worked at Bear Stearns earlier in his career. In March of 2008, the New York Federal Reserve agreed to provide Bear Stearns with a $25 billion loan in order to provide them with temporary liquidity and prevent a chain reaction in the financial system. However, shortly after, the Fed changed its mind and refused to give the loan. Instead, they agreed to form a company with a $25 billion loan that would take over Bear Stearns' assets, and Bear Stearns would be purchased by JP Morgan for $2 a share. Bear Stearns' stock price was $172 a share a year earlier, and $93 a share as recently as a month earlier. But this deal was seen as a major bailout of the bank that, according to Fed Chair Ben Bernanke, prevented a, quote, chaotic unwinding of investments across the US markets. Alright guys, that wraps it up for this video. It's always important to learn from history, especially in unprecedented economic times such as today. Let us know in the comment section below if you think the bailout of Bear Stearns was justified. Also, don't forget to like, subscribe, and share this video. As always, thank you guys so much for watching. Wall Street Millennial, signing out.